The option money pit, gambling, or genius? You decide. Booyah! Welcome to today's video where we dive into the reasons why option buyers often lose money. Is it just gambling, or is there a process behind it? Let's find out. Booyah! Welcome to today's video where we dive into the reasons why option buyers often lose money. Is it just gambling, or is there a process behind it? Let's find out. I'm Shaurya Singh, and let me tell you, I've seen it all. I've seen fortunes made, and more often, fortunes obliterated in the options market. People come in, eyes wide, thinking they're gonna hit the jackpot, that they've found the golden ticket to Wall Street riches. They hear the stories, the whispers of 10-baggers of turning a few bucks into a mountain of cash with one smart options play. But what they don't hear enough about, what doesn't make the flashy headlines, is the brutal reality for most option buyers. The truth is, folks, buying options can be like walking through a minefield blindfolded if you don't know what you're doing. It's not just about picking a stock and a direction, oh no, it's so much more complex than that. There are gremlins in the machine, silent killers waiting to snatch your hard-earned cash. We're talking about things that can turn a winning idea into a losing ticket faster than you can say, margin call. Are you tired of watching your option premiums vanish into thin air? Are you sick of feeling like the market is rigged against you? Good! Because today we're not just commiserating, we're educating. We're going to rip the cover off this thing and expose the 10 biggest reasons why so many retail option buyers get their heads handed to them. This isn't about scaring you away, it's about arming you with knowledge. Because understanding the pitfalls is the first step to avoiding them, to potentially turning the tables and maybe, just maybe, making some real money. So grab your notebooks, turn up the volume, and get ready, because class is in session, and Professor Shaurya, channeling his inner Kramer, is about to drop some serious knowledge bombs. Skedaddle! Alright, let's kick things off with one of the biggest, sneakiest destroyers of option buyer dreams, Theta. You hear that? Theta. It's the technical term for time decay, and believe me, it's a relentless beast. Think of it like an ice cube melting on a hot summer day. You buy that option, you pay that premium, and every single second that ticks by, a little piece of its value can be dripping away, disappearing into the ether, especially if that underlying stock isn't doing exactly what you need it to do, and fast. This isn't like buying a share of good old Procter & Gamble and holding it for your grandkids. No, sir. Options have an expiration date, a doomsday clock, and Theta is the sound of that clock ticking louder and louder as you get closer to expiration. This monster doesn't sleep. It doesn't take holidays. It's working against you 24/7, even when the market is closed. If your stock just sits there, if it trades sideways, if it doesn't make that big explosive move you were betting on, Theta will eat your premium for lunch, breakfast, and dinner. And it gets worse, folks. The rate of time decay accelerates as you get closer to that expiration date. It's like a snowball rolling downhill, picking up speed, getting bigger and more dangerous. So many traders, especially rookies, they buy an option, see the stock move a little in their favor, but then they watch in horror as their option's value stagnates or even drops. Why? Theta, baby. It's a force you have to understand and respect, or it will crush you. Next up, let's talk about the price of admission, the cost of playing the game, high premium costs. You want to buy an option? You gotta pay up. And sometimes, folks, you gotta pay up big time. That premium is the cold, hard cash you fork over to get in on the action. It's your maximum risk, sure, but it's also the hurdle your underlying stock has to jump over and then some, just for you to break even, let alone make a profit. Think about it. If you pay $5 for a call option, that stock doesn't just need to go up. It needs to go up by more than $5 from your strike price by expiration just for you to see green. That's a tall order, especially in a choppy market. And where do people really get hammered? They get lured in by those sexy high volatility names, the ones everyone's talking about. But guess what? High volatility often means sky-high option premiums. The market makers aren't stupid, they price in that expected movement. So you're paying an arm and a leg for the at a big move. Or they go for those far out of the money options, thinking they're getting a bargain because the premium is low. But the odds of those paying off? Slim to none, and Slim just left town. You're essentially buying a lottery ticket with a slightly better payout structure, but it's still a long shot. That premium is a direct hit to your potential profit, a headwind you're fighting from the second you click buy. Listen to me on this one because it's crucial. Many, and I mean many options, especially the ones that wide-eyed speculators love to buy, have a low probability of success. Statistically speaking, a huge percentage of options expire worthless. Worthless. That means the premium you paid, poof, gone, vanished, adios. People buy these things, especially those far out of the money calls or puts, dreaming of 1,000% return, a home run, a grand slam. They see a cheap option and think, what have I got to lose? Well, you've got your entire premium to lose, and the odds are stacked against you from the get-go. It's like betting on 100-to-1 underdog in a horse race. Sure, if it wins, the payout is massive, but how often does that happen? Rarely. The market knows this. The sellers, the institutions, they know this. They're often selling you those lottery tickets, collecting those premiums because they understand the probabilities. They're playing the numbers game. Buying options hoping for a massive unexpected move is often more akin to gambling in a casino than it is to strategic investing. You need a confluence of factors, right direction, right timing, right magnitude of the move, all before that expiration clock runs out and Theta eats your lunch. It's a tough game, folks, and the probabilities are not always your friend when you're just buying. This one makes me want to scream. Lack of risk management. So many traders, especially the newer ones, dive into options without a parachute, without a seatbelt, without a prayer of surviving a bad trade. They buy an option and that's it. No stop loss, no plan for when to cut losses, no idea how much they're really willing to see disappear. They just watch, hope, and pray as a trade goes against them, sometimes riding it all the way down to zero. That's not trading, folks. That's financial suicide. Your capital is your lifeblood in this game, and if you don't protect it, you'll bleed out. Fast. You absolutely, positively must have a risk management plan for every single options trade. How much of your premium are you willing to lose before you say, enough is enough? Is it 20%? 50%? You need to define that before you enter the trade, not when you're panicking as the red numbers flash on your screen. Setting a mental stop loss, or even a real one if your broker allows for options, is not a sign of weakness. It's a sign of professionalism. It's what separates the gamblers from the traders. Failing to manage risk is like driving a race car without brakes. You might have fun for a little while, but eventually, you're going to crash and burn. Don't let that be you. Preserve your capital. Now let's talk about the elephants in the room, the gorillas on Wall Street market manipulation and institutional control. You think you, as a little retail trader, are playing on a perfectly level field? Think again. The big institutions, the hedge funds, the market makers, they have resources, information, and firepower that you can only dream of. They can move markets, folks. They can trigger stops, they can create short squeezes, they can paint the tape. It's not always some nefarious illegal conspiracy, but they are definitely playing a different game, with different rules and a much bigger stack of chips. These large players often act as the sellers of the options that retail traders are so eager to buy. They have sophisticated models, they hedge their positions, and they understand how to exploit an edge. They can see the order flow, they know where the pain points are for the little guy. This doesn't mean you can't win, but it does mean you need to be aware that you're swimming with sharks. You can't just blindly follow the herd or assume that the market will behave rationally or fairly. Sometimes those strange, inexplicable price movements that wipe out your option, that might just be the footprint of a whale. You gotta be smart, you gotta be nimble, and you gotta understand that the house, in many ways, has an edge. Chapter 6. Gut feeling follies, emotional trading, and no strategy. This one drives me bonkers. Emotional trading and a complete lack of strategy. People trading options based on your gut, on a hot tip from your brother-in-law, or because you're feeling FOMO, fear of missing out, is a recipe for disaster. Your emotions are your worst enemy in the trading arena. Greed makes you hold on too long, hoping for that extra buck, only to watch your profits evaporate. Fear makes you sell too early, missing out on a bigger move, or worse, panic sell at the bottom. And FOMO makes you chase stocks that have already run up, buying expensive options at precisely the wrong time. You need a plan, a strategy, a well-thought-out, researched reason for every single trade you make. What's your thesis? Why do you think this stock is going to move? What's your target price? What's your exit strategy if you're right? And just as importantly, what's your exit strategy if you're wrong? Trading without a strategy is like trying to navigate a maze blindfolded. You'll just bump into walls and end up lost and frustrated. You need to do your homework. Understand the underlying asset, understand the option you're buying, and have a clear, unemotional plan of attack. Leave your feelings at the door because the market doesn't care about them. Chapter 7. The Still Pond. When low volatility drowns your options. Let's talk about another dream crusher for option buyers. Low volatility. You buy an option, especially a call or a put, because you're expecting a move, right? You need that underlying stock to go up for calls or down for puts, and ideally to do it with some gusto. But what happens when the stock just sits there? What if it trades in a super tight range, flatter than a pancake on a Sunday morning? Well, my friends, that's when low volatility becomes your enemy, working hand in hand with that other villain, Theta, to erode your premium. Option prices are heavily influenced by implied volatility, the market's expectation of future price swings. If a stock is just snoozing, if there's no news, no catalyst, no excitement, then implied volatility can drop. And when implied volatility drops, the price of your option can drop too, even if the stock price hasn't moved against you. It's called volatility crush or Vega risk, and it can be a brutal lesson for unsuspecting buyers. You might be right on the direction, but if the move isn't big enough or fast enough, or if the overall market calms down, your option can still lose value. You need that vroom vroom, that zigzag, that boom. If the pond is too still, your option boat is going to sink, slowly but surely. You need some waves, people. Chapter 8. Apples and oranges. Treating options like common stock. This is a rookie mistake, but I see it all the time. Treating options like they're just another version of stocks. No, 1,000 times no. They are fundamentally different beasts, and if you don't understand that, you're doomed to lose money. When you buy a stock, you own a piece of a company. You can hold it for years, decades even, collect dividends, and participate in the company's long-term growth. There's no expiration date breathing down your neck. But an option? An option is a contract. It's a depreciating asset with a ticking clock, an expiration date. It gives you the right, but not the obligation, to buy or sell a stock at a certain price for a certain period of time. You cannot buy and hold an option in the same way you buy and hold Apple or Microsoft. That option you bought, thinking it's a cheap way to play a stock, will expire. And if it's not in the money by that date, it's worthless. Kaput. Zero. Many traders make the mistake of holding on to a losing option, hoping it will come back, just like a stock might. But with options, time is actively working against you. That Theta decay we talked about, it's munching away at your premium every single day. You need to be an active manager of your option positions, not a passive holder. They are trading vehicles, not long-term investments. Get that through your head. Chapter 9. The siren song of cheap buying far out of the money OTM nightmares. Ah, the allure of the cheap seat, the siren song of the far out of the money option. OTM options, folks, these are the ones where the strike price is way above the current stock price for calls or way below it for puts. And why do people buy them? Because the premium is low. They look at it and think, wow, I can control 100 shares of XYZ for just a few bucks. If this thing moves, I'm gonna be rich. It's the lottery ticket mentality all over again, and it's a dangerous, dangerous trap that snares so many unsuspecting traders. Yes, the premium is low, but there's a reason for that. The probability of these OTM options ever becoming profitable, of ever even reaching their strike price, let alone exceeding it by enough to cover the premium, is incredibly slim. The market is pricing them cheaply because the odds are overwhelmingly against them. You need a monstrous move in the underlying stock, a black swan event, a miracle, for these things to pay off big. And while miracles do happen, they are, by definition, rare. Most of the time, these OTM options expire worthless, and the sellers of those options just pocket your premium, week after week, month after month. Buying OTM options consistently is one of the fastest ways to bleed your account dry. You're paying for a hope and a prayer, not a sound trading strategy. Chapter 10. Tip Traps and Advisory Ambush. The Peril of Blind Faith. Finally, let's talk about something that gets people into hot water faster than a greased pig on a water slide. Over-reliance on tips and advisory services. I see it everywhere. Social media gurus, Discord channels, subscription newsletters, all promising the next big winning options trade. Buy this call now. This put is a guaranteed winner. People, you have to be careful. Following tips blindly, without doing your own research, without understanding the underlying thesis, without a grasp of the risks involved, is like letting a stranger drive your car off a cliff. Nobody, and I mean nobody, cares more about your money than you do. These services, these so-called experts, they might have a good run now and then, but they're not infallible. They have their own agendas. Sometimes they're right, sometimes they're spectacularly wrong. And guess who pays the price when they're wrong? You do. You need to develop your own skills, your own analytical abilities, your own trading plan. Use information from others as a starting point perhaps, for ideas, but then you must do your own homework. Verify the claims, understand the setup, assess the risk-reward. Don't just click buy because some anonymous avatar on the internet told you to. That's not investing, that's gambling on someone else's opinion, and it's a surefire way to end up broke and bewildered. Think for yourself. Outrow knowledge is power. Trade smarter, not harder. Woo! We covered a lot of ground today, didn't we? From the silent killer Theta to the dangers of emotional trading and blindly following tips, it's clear that buying options isn't a walk in the park. It's a challenging arena, and if you go in unprepared, the market will chew you up and spit you out. But here's the good news, and listen closely. Understanding these pitfalls is the first, most crucial step towards avoiding them. It's about shifting your mindset from that of a gambler hoping for a lucky break to that of a strategic trader who understands the risks and plays the probabilities. The goal here isn't to scare you away from options entirely. When used correctly, with a solid strategy and disciplined risk management, options can be powerful tools. But you've got to respect the game. You've got to do your homework. You've got to understand what you're buying and why. Don't let these common mistakes derail your trading journey. Learn from them, adapt, and strive to be a smarter, more informed trader. Remember, knowledge isn't just power. In the world of options, knowledge is survival and potentially profit. So take these lessons to heart. Rewatch this video if you need to. Let these warnings sink in. The path to becoming a successful options trader is paved with education, discipline, and a healthy respect for risk. Thanks for watching. If you found this video helpful, don't forget to like, share, and subscribe for more insights into the world of trading and investing. See you next time. Booyah! Stay mad, but trade smart.